Hey, what's up, everyone? It's Sean Rampersaud here again, coming to you with another awesome topic. Today, I'm going to be talking about refinancing property. This video is called Refinancing 101 because I'm going to talk to you right from the beginning what refinancing is about, how to refinance a property, what benefits refinancing will do for you, and really explain to you if refinancing is going to be for you or if you should just kind of put that on the back burner. If you do like this video, please like and subscribe to the channel. It helps me rank higher on YouTube so this video can get out to the people that it needs to get out to so that they can save money. I thank you and I appreciate that ahead of time. So first and foremost, what is refinancing? So refinancing is when you get rid of a current debt obligation. So you cancel a current mortgage in order to put in a new mortgage in its place. So a new debt obligation is going to come in place. So basically, you're getting rid of the old mortgage and you're getting a new mortgage with new terms and conditions. So why do people refinance? That's the question. So a lot of times people are refinancing in order to, one, pay off debt, two, put some money in their pocket, possibly, three, and maybe to get lower payments. But I'm going to go through 11 reasons why people refinance a property. And out of these 11 reasons, you might find something in there that you may be interested in. So if you do have any questions about refinancing a property anytime, please feel free to give me a call. My contact information is in the comments below. So number one is to pay off high interest debt. So a lot of people over time, and I see this on an everyday basis because I do the job that I do, but I see people that are drowning in credit card debt. Now, credit card debt has interest rates as high as like 29%. So you want to make sure that your payments are going to be lower if you were to amalgamate all of your debt into a mortgage instead of a credit card or a line of credit. So you might have a credit card, you might have a line of credit, you may have car payments, you may have student loan payments. I don't know what you have, but what I would do is I would total up what your minimum monthly payments are, and your minimum monthly payments are interest only normally. So that means that you're not paying off any of the debt if you continue with those monthly payments. Now, I could get you a mortgage potentially, or you could refinance your mortgage and build all of that in so that you have one single monthly payment. And the interest rate on a mortgage is, of course, much, much lower. I think the average over the last 25 years is probably 5%. So your interest rate on a mortgage is lower. The amount of time that they give you to pay it off is longer. So your overall monthly payments could go way down, put you in a way better financial position to pay that debt off. Next, to pay taxes. So it could be a multitude of different taxes, and I've done other videos on this, but one, it could be property taxes. If you're back on your property taxes, they could put a lien on your property. So it could be to pay your property taxes. Two, it could be just to pay your regular personal taxes or maybe your corporate taxes if you own a business. That's a surefire way to get a lot of cash out of your property is by refinancing that property. Three, God forbid, you break up with your girlfriend that's on title, or boyfriend or husband or wife, divorces, separations. Oh my God, it's a disaster. So basically, what you can do and what normally happens is if the property is in both people's names, one person has to get paid out. The only surefire way to pay that person out of the mortgage and for you to qualify on your own would be just to refinance that property, pay out your ex, get them off of your property. They have their cash, they can walk away, and it's called a spousal buyout. And I'm doing another video specifically on spousal buyouts. You can also get more information on my website. I'll put the link below in the description. To get a lower interest rate, that's just another thing. So if you are a smart investor, you're always trying to save money. So you're always trying to get a lower interest rate. The rates that you have is at 6%, and you are trying to get a lower rate, and the rate of today is only 2% or 3%. You could save a significant amount of income. So what I would do is I would have your mortgage broker or your bank or whoever to run an amortization schedule for you. Just message me if you want to know what that is. But basically what they can find out is how much you're paying over the next 5-year term of your mortgage, current situation versus what you would be paying at the 2% interest rate. And then they'll tell you how much money you could save. So you would take your total payments here minus your total payments here. So what you currently have minus what you could have with a new payment with a lower interest rate, and multiply that by the 5-year term. And that's how much money you would save over the term of your mortgage if you were to refinance for a lower interest rate. Some people want just lower payments. And if you can't lower your interest rate, there's no other way to get lower payments other than to stretch out the amortization of the loan. That means to put the loan back over a 25-year term, as an example. So you could do that by refinancing your property and get lower payments. So if your payment is currently $2,000 a month and you refinance, you stretch the mortgage out another 5 years or something like that, you could lower your payments as low as $1,500 a month, save you $500 a month, and put you potentially in a much better financial position. You can always pay the property off faster if your situation changes. To buy a vehicle. So, depending on the situation, if you own a business and you need to buy a work truck or something, it could be really expensive, and you might want to build that payment into your mortgage. So, a lot of people refinance their properties to buy a vehicle kind of outright. It gives them negotiating power when they get to the dealership. They say, "Okay, I'll take that vehicle cash," as an example. So you might be able to refinance your property to pay off a vehicle. To start a business with the equity in your home, a lot of people don't have a lot of cash saved up. You might yourself. I don't know what the circumstances are, but you may want to take money out of your property to start a business. So, as an example, if you wanted to buy a Wendy's or a McDonald's or something like that, and you've got a bunch of equity tied up in your house, they want to see liquid cash in your bank in order to qualify for the franchise. So you may need to take out $500,000 or $600,000 out of your house equity, money that you have sitting there that is paid off, in order to purchase the business. The most common is down payment for a new house. So most people, their cash is tied up in a property. So if they don't have a line of credit or anything like that, they may need to refinance the property to take money out of property A to buy property B. And finally, you may refinance to pay your mortgage off faster. So you change the terms of the mortgage to pay that mortgage off faster. Let's say that you're wanting to retire in 10 years, as an example. You may want to lower your amortization from 15 years to 10 years so that you can retire in peace and have your property paid off. If you like the video so far, please like and subscribe to the channel. Don't forget to do that. There's a lot more video coming up. So let's go through some common questions about refinancing a property. Number one, what credit score do you need to refinance a property? So the minimum credit score to refinance your property is a 600 credit score. That would be with like regular banks, regular financial institutions, that type of thing. If you've screwed up your credit and your credit's sitting at 400, 500, anywhere between 400 and 600, then we need to get you refinanced through a B lender. It can be done. So call me if you have any questions like that. I can get you approved, potentially, if you have enough equity with another lender other than a bank, if your credit score is lower than 600. If it's 600 or above, then call me anyway. I'll get you the lowest rate at any bank that we work with. Is a mortgage tax deductible if you refinance the property? So this gets me into a topic called the Smith maneuver. But yes, if you refinance your property, it can potentially be tax deductible. So as an example, let's say you refinance to take money out to go and buy the business, then your mortgage would be tax deductible. The additional 500 grand, or for example, that you took out. Or if you took it to buy a rental property, that type of thing, then the mortgage is definitely tax deductible. So how do you refinance a mortgage? So step one would be to call myself or call your bank and let us know what your goal is and the reason is for refinancing. Okay. After that, you're going to fill out a mortgage application just like you would as if you were getting a regular mortgage. You fill out the mortgage application, you send us in your documentation, and then we will work on the refinance. I go and shop around at every bank for you, find out who's going to give you the lowest interest rate, and they give me lower rates than they would give you anyway. So make sure you give me a call if you are planning to refinance your property. So, should I refinance? That's a question that a lot of people have for me. Not necessarily. And yes, potentially. So, if you are going to save money on your overall monthly payments and you need to be in a better financial position and refinancing is the way to do it, then yes, you should refinance. If you are lowering your debt load by amalgamating everything into your mortgage and the payments are way lower, then yes, you should refinance. If you are refinancing just to change your payments, then I don't know if it's necessary to refinance. If you need it, then you need it. You have to do what's right for you. So definitely call me about that. I'm not trying to convince anyone that you should refinance. I'm just explaining what refinancing is all about to you. I'll let you know what my opinion is and if you should refinance or not. What banks will refinance a mortgage? I'll tell you, every bank are willing to refinance a mortgage. Every single one of them. They want to retain you as a customer, but you have to qualify for it. That's the only thing. So you're gonna want to give me a call and have me check if your bank is willing to refinance that mortgage with you, or you can go directly to your bank, whatever you prefer. Does it cost money to refinance the mortgage? Yes, it does cost money to refinance a mortgage. I know a lot of bankers, other brokers might tell you that it costs nothing, but it does cost money to refinance a mortgage. Number one, you may have penalties. So, payout penalties. You want to check with your bank and make sure that you don't have any payout penalties. If you're on a variable rate mortgage, for example, your payout penalty should only be about 3 months interest. If you're on a fixed rate, it could be much higher than that. If you're at the end of your term, then there is probably no payout penalty. There are other expenses. So some of the other expenses might be an appraisal. So an appraisal can cost $400. Might even cost a little bit more than that, depending on where you're from. Some banks that you've refinanced with will pay for that appraisal. So just to let you know that it can be paid for. So that may not be an expense. One of the sure expenses that you're going to have is legal fees. So there could be legal fees as low as $250 all the way up to $1,200, depending on how much involvement the lawyer has to have. We do work with companies like FCT that don't charge any major legal fees. I think it's $250 for a refinance. So, but there are definitely some expenses involved in refinancing. So here's a little tip that I have. This is a refinance secret that I use to get people more money when they're refinancing their property. So I know a lot of appraisers, and I know a lot of good ones, and I know a lot of bad ones. So I try to put you with an appraiser that is taking into consideration the current market values. If an appraiser is looking at the last year of what's happened in real estate, they may evaluate your property too low. So I make sure I put you with one of the appraisers that go over and above what they have to do to find the value. They'll add back value for different things. For example, if you have a suite in the basement, they'll add more value to your property than that. Because what they're doing essentially is they're taking all of the solds and all of the active properties in your area, and they're trying to create an evaluation of what your property is based on the type of property, the size of property, the condition of the property, that type of thing. So they're looking at all of these things. So I want to put you with an appraiser that I work with so that they can give you top value for your property. Then I would place you with a lender that will consider that top value and refinance you for the maximum amount. So if you're trying to get as much cash out, you need to call me ASAP. Again, my information is below. Please like and subscribe to the channel, and thank you very much for watching the video. If you have any questions, call me anytime. Thanks.